Welcome to the deep dive. Today we're cracking open a philosophy that has really redefined how millions of people think about their income, their careers, and, well, their entire life trajectory.
That's right.
We've taken a stack of powerful source material centered around the famous cash flow quadrant framework.
Yeah.
And our mission today is to deliver the absolute clearest, most actionable insights you need to understand this system.
And decide if it's a path for you.
Exactly.
Yeah, and it's so much more than just a financial discussion. I mean, that's the surface level. What we're really talking about is human development and mindset.
Right.
The sources make it intensely clear that, yes, we're looking at where income is generated, but more profoundly, it's about the kind of person you need to become to generate income from these different places.
The person you become.
The essence of this whole exploration is really captured by a concept referenced in the material, which is the path is the goal.
You know, that idea that the path is the goal is so deeply countercultural.
It is.
Because traditionally, we're conditioned to just focus on the destination, right?
Yeah.
The high-paying job, the impressive title, the number in your retirement account.
The end result.
The end result. But you're saying, based on these sources, that just finding your life's path, your purpose, that is the goal itself, regardless of what your job title is right now.
Precisely. And this is really where the system critiques conventional education.
Okay.
If you look at schooling, the entire system is designed to develop students almost exclusively mentally. We train people to go to school and get a job, which typically fits them for the E or employee or S self-employed quadrants, which we'll define in a second.
Right.
But the material highlights the systemic failure. Traditional education often crushes the emotional and spiritual development that's required for true success.
How does it do that? How does it crush the spirit? Is it the process itself?
Absolutely. The dominant motivator used in traditional schooling is the emotion of fear. Think about it. Fear of making mistakes, fear of failing a test, fear of not getting into the right college, then fear of not landing a secure job. This whole environment where mistakes are punished and discouraged, it's fundamentally toxic to the mindset you need to build something big.
Or to innovate, or take any kind of calculated financial risk.
Exactly. And that explains why so many people who were brilliant A students in school, they get out into the real financial world and they struggle. They struggle significantly.
Because the rules are completely different.
The rules are different and the emotional skill set is different. I mean, to become a whole human being who can really thrive financially, you need 4 types of personal development: spiritual, emotional, mental, and physical.
And schools only focus on one.
They focus intensely on the mental, leaving the other 3 completely underserved. And this pattern it's reflected in history. Look at massive entrepreneurial successes. Thomas Edison, Henry Ford, Steve Jobs, Bill Gates. They often lack the traditional high-level academic credentials. The system that demands perfection from a textbook it's fundamentally incompatible with the risk-taking and, frankly, the failure that's required of a leader in the B or I quadrants.
Okay, let's unpack this core framework then. Because before we can decide what steps to take, we need to know exactly where we are on this map.
The CASHFLOW Quadrant. It's essentially an emotional and technical classification system. It categorizes people based on where their money comes from.
Where the money comes from.
And each of the 4 categories, it demands a distinctly different technical skill set, a different personality profile, and this is the most important part, a different frame of mind.
Okay, let's start with the left side, which is where most people are. The E quadrant is for employee. What defines them at their core?
The employee, they earn money by holding a job and working for a company or another person, and their fundamental core value is security.
Security. Above all else.
Above all else, they want certainty. And they want it codified, literally in writing in a contract or an employee handbook. The sources stress this over and over. Uncertainty doesn't make an E-type happy. Certainty does.
The security is more important than the money, in a way.
In many ways, yes. Security is almost always more important than maximizing their potential income.
Then we move to the S quadrant.
Yeah.
Self-employed or small business owner. This could be a doctor, a lawyer, a consultant, a tradesperson. Still on the left side, but their motivation feels really different from the E.
It is different, but they share the same fundamental limitation, which is trading time for money. See, the S owns a job. They don't just have one.
They own it.
They own it. They're often perfectionists whose independence trumps even a high income. Their core motto is usually something like, nobody does it better than me, or, I did it my way.
Ah, the classic S-type trap.
It is. Because they don't trust anyone else to do the work perfectly, they become the system. So if that world-class consultant or that skilled plumber stops working for a day or a week,
The income stops flowing instantly.
instantly.
That distinction, owning a job versus holding a job, that is so subtle, but it's absolutely crucial. Okay, let's cross the line to the right side, where the sources argue true financial freedom really begins. The B and the I. Let's start with B for big business owner.
The true B type, they own a system, and they hire competent people to operate that system for them. The crucial difference is the B focuses on the infrastructure, not the day-to-day work. They're the complete antithesis of the S.
So their motto isn't "I do it best."
No, their motto is why do it yourself when you can hire someone who can do it better. Their whole focus is on leadership, delegation, and systematization.
So the system works for the B. What's the litmus test for whether someone is a true B or just a really successful but overworked S?
The test is actually really simple. Can the owner leave the business entirely for a year, maybe more, and come back to find it running better, more efficiently, and more profitably than when they left?
The whole year.
A whole year. If the business requires the owner's presence to function, it's an S business. If it thrives in the owner's absence, it's a B business.
And that brings us to the ultimate goal, the I, the investor.
The investor is the quadrant where money generates more money. It's completely separate from your personal time or effort. They focus intensely on systems and assets working for them, not just income, but passive, leveraged cash flow.
So they're not just looking for a good salary.
Not at all. They're looking for terms like internal rate of return, cash-on-cash return, and interestingly, they get excited by the word risk.
Which terrifies most people on the left side.
Exactly. So this fundamental divide between the left side E and S and the right side B and I, it's really about how they define security, isn't it?
It seems so. The left side is all about job security.
Right. Well, the right side pursues financial freedom and long-term security through assets.
And that left side idea of job security, the sources argue that's practically obsolete now.
Especially in the information age, yes. It's an illusion. The right side offers real security through asset creation and leverage. And this leads us to the mechanism that makes the right side capable of wealth generation on a completely different scale.
And that's leverage.
Leverage specifically through OPT and OPM.
Other people's time and other people's money. Okay, I have to stop you there because for a lot of listeners, using OPT and OPM, that might sound a bit exploitative. How do the sources frame that ethically?
That's a critical question, and it really gets to the morality of capitalism. The B quadrant leader's leverage isn't derived from exploiting an employee. It comes from creating a system that benefits many people.
Okay.
The E and S types, they often are the other people whose time and money are being used, but they're participating willingly in a system that was built by the B type. The B provides the structure, the vision, the capital, and the security for the system to even exist, which allows the E to earn a regular, stable paycheck.
So the difference is what they're paid for.
Exactly. The B is paid for creating and owning the system, and the E is paid for their time within that system.
So success for an S-type means they just work more hours, which is linear. But success for a B-type means they improve the system, they hire more competent people, and they can actually work less while earning exponentially more.
Yes, because they're leveraging the productivity of hundreds, maybe thousands of people. That ability to harness OPT and OPM is, it's mathematically impossible when you're just trading your own time directly for money like the E and S types have to.
And to really make this concept stick, the sources use that fantastic metaphor, the story of Ed and Bill, the water haulers.
It's the perfect illustration of the two mindsets. So the village needed water. They hire Ed and Bill, Ed, the classic S-type. He immediately buys 2 buckets and starts hauling water from morning till dusk.
Hard worker.
A very hard worker. He's physically strong, he gets that immediate gratification, and he's proud to be earning money from his labor. But then a competitor comes in, offers a lower price. What does Ed do?
Works harder.
He just lowers his rates, buys 4 more buckets, and works even longer. He owns a difficult job, and he's perpetually just trading his time for money.
And Bill, the B-type.
Bill took his time. He saw the long-term vision. He thought, if this one village needs water, probably thousands of villages across the region need water, too.
He thought bigger.
Much bigger. So instead of hauling buckets, he spent 2 years writing a business plan, raising capital, and designing a high-speed, high-volume, low-cost, clean water delivery system. a pipeline.
A system.
A system. And today, Bill's pipeline delivers billions of buckets of water every day. He might only make a penny per bucket, but the system generates passive income for him whether he works that day or is on vacation or is sleeping.
That is the difference between owning a job and owning a system. And the sources really emphasize that making this transition, it doesn't require you to be rich already. I mean, the author and his wife were literally homeless in 1985.
Living out of a car.
And by 1989, they were financially secure.
That detail is so crucial because it underscores that the shift is purely intellectual and emotional. It's not capital-driven, not at the start. It didn't take high education. The author failed English twice. It just took an understanding of these quadrant differences and a fundamental psychological commitment to building a system.
Which brings us to the core difference. It's not about the job, it's about the mindset.
The shift from the left side to the right side is, well, it's way beyond a career pivot. The sources describe it as a change at the core of who you are.
The core of who you are.
It's how you think, what you value, how you look at the world. It's a profound and sometimes a pretty painful transformation.
And the primary driver of this transformation is how you react to financial pressure. We touched on this. E&S types, when they face financial pain, they choose security. They retreat.
They retreat to what's familiar. But the B&I types, they choose freedom. They move toward the challenge.
So they use that same fear differently.
Exactly. That's the central emotional distinction. When the fear of losing money or the pain of debt becomes acute, the ES type seeks the comfort of a guaranteed paycheck. The BI type uses that same fear as the energy to seek out financial education and learn how to manage risk, which ultimately leads to freedom.
Let's go back to the A student trap. You said traditional education can cripple people emotionally. How does that academic mindset prevent the action you need in the B&I quadrants?
Well, academic environments reward precision, and they discourage error. The sources call the fear of error that results from this an emotional psychosis,
Wow.
which leads to analysis paralysis. If you are paralyzed by the fear of making a mistake, you will never take the decisive, sometimes messy action that's required to build a system or make a profitable investment. You'll just study it forever.
The famous quote from Thomas Edison comes to mind here about the light bulb.
It's the perfect example. When he was criticized for his 1,014 failed attempts, Edison said, "I did not fail 1,014 times. I successfully found out what did not work 1,014 times."
A complete reframing of failure.
A complete reframing. People fail to achieve financial success because they fail to fail enough times. They quit after the first setback because that emotional programming from school tells them that failure means they're inherently bad or stupid.
So it's a huge lesson.
Yeah.
Stop seeking perfection and start seeking knowledge through trying things. And this mindset difference, you say we can literally hear it in the language people use.
Oh, absolutely. Rich Dad taught that if you listen carefully to people's words, you can hear their core values. You can hear their souls, even.
Okay, let's map the language of each quadrant. What are the common phrases or values of an E-type?
The E-quadrant vocabulary is all about stability and minimizing risk. So you'll hear words like safe, secure, benefits, good pay, I need certainty.
And the S-type, it's all about control, right?
Exactly. Their language reflects their need for personal control and that perfectionism. So you hear, my way, I'm going to do my own thing. What is my hourly rate? And the big one, nobody does it better. They feel like their personal genius has to be directly involved in everything.
How does that contrast with the B-quadrant language?
B-types talk in systems and delegation. They use words like, system, I need to find the best people. Who is running the company for me? They speak about organizational structure, not individual tasks.
And the I-quadrant vocabulary is all about financial metrics.
Entirely. The I-quadrant uses technical terms focused on return and the management of money. Cash flow, internal rate of return, diversification, and critically, risk.
The word that terrifies the E-type.
It terrifies them. It might lead them to hide money under a mattress. But it excites an I-type because they see risk is manageable and they know it's directly correlated to potential return.
This just highlights how crucial emotional intelligence is for finance. The sources cite Daniel Goleman's work, pointing out that financial IQ is maybe 90% emotional IQ and only 10% technical information.
The sources go even further. They reference Erasmus of Rotterdam, a 16th century humanist who suggested the emotional brain is 24 times more powerful than the rational brain.
24 to 1.
24 to 1. So when high-stakes financial emotions like greed or fear or envy kick in, logic often doesn't stand a chance. And that explains why highly intelligent people make terrible financial decisions. They know what they should be doing, but the fear of losing money makes them freeze.
Or greed makes them take ridiculous gambles.
Right. So financial struggles are, at their core, driven by emotional phobias about money.
And making that shift requires what the sources call financial adulting.
Yes, the parent versus child voice analogy. The internal financial parent voice says, you should pay off that credit card debt immediately. But the financial child voice whines, but I really feel like taking a vacation. I'll just put it on the card.
We've all heard that voice.
We all have. Financial adulting means knowing what you must do, like paying yourself first and investing, and then you just execute it, even if you don't feel like doing it in the moment.
Okay, so if freedom is the goal, the path is through the B and I quadrants. We need to dissect that difference between S and B again, because so many S-types proudly call themselves entrepreneurs, but they've just bought themselves a really difficult, unscalable job.
That is the essential system gap. The S is the system. The B owns the system. To put it another way, if the S leaves, the business dies. It needs their personal skill set.
It's tied to them physically.
Completely. To evolve from an S to a B, you have to convert your personal genius and knowledge into a scalable, replicable system that's run by other competent people. And this is incredibly hard for the S-type because their perfectionism is directly opposed to the delegation that's required for a B.
The ultimate S-type example might be that high-level professional, like a dentist or an architect. They can charge enormous fees, but they can't bill a single dollar when they're not physically present.
That's it. Their success becomes a prison. They are paid very, very well to be trapped by their own expertise. To make that shift, they have to look beyond their specific skill and start thinking about the logistical, training, and financial systems required to deliver that skill at scale, reliably, without them.
The McDonald's analogy is perfect for this. I mean, if I told you I could make a better hamburger, you'd probably agree with me.
I probably would.
But the sources challenge us to ask a different question. Can you build a better system than McDonald's?
And that's the pivot point. The focus has to shift entirely from the product, the better burger, to the robust, standardized, globally scalable business system.
It's not about the burger at all.
It's not. When you move to the BI side, you don't just look at the hamburger. You observe the entire ecosystem. The standardized training that ensures a teenager can run the operation reliably, the complex logistics of the supply chain, the real estate model, the sophisticated Wall Street financing that funds the whole thing. The system is what delivers billions of burgers, not the quality of one patty.
So if systems are the bridge from the left side to the right, what are the actionable structures that a person can use to actually make that transition?
The sources define three main ways to become a successful B-type. First is the traditional C corporation, where you develop your own system from scratch.
The hardest path.
By far the riskiest. It means creating all the manuals, training protocols, financial structures yourself. The author notes that typically you might lose 2 or 3 companies before you build one successful system that lasts. Because success is a poor teacher, you learn the most when you fail spectacularly.
Okay, what's path number 2?
Second is franchises, where you buy an existing, tried and proven operating system. This removes the variable of having to create it yourself.
So you're buying certainty.
You're buying a proven system. This lets the aspiring B focus only on managing and developing people within a pre-approved framework. But there's a massive warning here. Franchises are a terrible fit for the S-type perfectionist who insists on doing it their way.
Because you can't.
You can't. If you buy a franchise, you have to act like a compliant E-type and follow the instructions exactly. If you try to meddle and improve the proprietary system, you'll inevitably end up in conflict with the franchisor and probably fail.
And the third path, which has a much lower barrier to entry, is network marketing.
Often called multi-level marketing or direct distribution, yes. This is essentially buying into a personal franchise system for a very minimal cost, often less than a couple $100s. Technology has automated most of the paperwork, distribution, and accounting, freeing you up to focus entirely on building your network.
Now, network marketing can be controversial. There's criticism about saturation and profitability.
Yeah.
How does the source material address that skepticism?
It addresses it head-on. The sources are clear. If you look at network marketing, you shouldn't focus primarily on the product. You should focus on the education and the mentor program that's offered.
So the real value is the personal development.
The real value is the internal development it provides. It's the system that builds the person, not just the income stream. The goal is to become a B-type leader. In this environment, it forces you to learn crucial B quadrant skills. Overcoming shyness, handling rejection, building self-confidence, leading a team, and selling a vision. If the organization is committed to developing you as a human being and gives you access to mentors who are already successful on the right side, it functions as this invaluable bridge. It mitigates the emotional and educational gap between S and B.
Okay, so in terms of the safest, most effective progression to financial freedom, what's the recommended path through the quadrants?
The recommended path is E to B to I.
Not E to I.
Definitely not. Jumping directly from E or S into I, the investor quadrant, is incredibly dangerous.
Why is that?
Because building a successful B first provides two critical things you need for the I quadrant: free time and substantial cash flow. Investing successfully is both capital intensive and knowledge intensive. If you start in the I quadrant without enough capital, you're operating at the red line. A single mistake or a market downturn will just bankrupt you.
So building the B first cushions you from that risk.
It completely mitigates that financial risk. It allows you to learn the investing game using excess capital, not your survival money.
That makes perfect sense. The business generates the capital and gives you the time freedom you need to study and manage complex investments. Okay, let's delve deep into that final quadrant now.
Right. Moving into the I quadrant is the ultimate goal, but as we've said, being uneducated is the real risk. So the sources break down the I quadrant into 5 distinct levels of investors.
Level 1, the zero financial intelligence investor.
These people can often earn very high incomes, but they invariably spend more than they earn. Their entire financial life is about keeping up appearances. Everything they buy, expensive cars, huge houses with high maintenance, it all loses value or costs them money.
So they're generating bad debt.
All bad debt. They confuse liabilities with assets, and when the economy turns, they are often the first to crash because they have no financial reserves, no cash flowing systems.
Level 2, the savers or losers investor. Now, this is probably the most provocative claim in the material because saving money is the bedrock of conventional financial wisdom.
It is conventional wisdom, but the sources argue it's dangerously outdated advice. And the reasoning traces back to 1971.
What happened in 1971?
That's when President Nixon officially took the U.S. dollar off the gold standard. Once that link was severed, the dollar became a fiat currency. It's basically a representation of government debt. The sources argue that since then, money has become a counterfeit dollar that can be created at the speed of light.
Okay, I have to push back here. The sources are essentially asking people to reject what their parents and every financial journalist told them. How can they justify calling the U.S. dollar debt and counterfeit? And why does this make savers the biggest losers?
Because the very nature of money changed from being a hard asset to a rapidly depreciating one. The sources highlight that since 1971, the dollar has lost approximately 95% of its purchasing power compared to gold.
95%.
So savers are just accumulating units of government debt that are perpetually eroded by inflation and government monetary policy. When governments need money, they just print it, which devalues everything the saver has so diligently put away.
What about supposedly low-risk investments like government bonds, which so many retirees rely on?
Yeah.
The sources categorize bonds as fundamentally risky in this modern context. For instance, if you hold a government bond paying 3% annual interest, but the real rate of inflation is running at 5%, your real wealth is actually crashing by 2% every single year.
You're losing money by being safe.
You're losing purchasing power. And the financial crisis of 2008 exposed the massive inherent risk in complex bond markets, like mortgage-backed securities, which everyone thought were safe. Professional investors constantly move their money into assets that appreciate. Savers just park their money, which makes them vulnerable to this invisible taxation through inflation.
Okay, level 3, the I'm too busy investor. This is the person who delegates their financial life.
Exactly. They believe they're too busy to learn, so they just hand their savings over to an expert, a stockbroker, a mutual fund manager, a financial planner. But crucially, these experts are typically E or S types themselves. They get paid through fees and commissions, not from generating successful returns on their own assets.
And what's the fatal flaw for this type 3 investor when they lose money?
They learn absolutely nothing. They just gain a bad experience and a reason to blame the advisor or the market or just bad luck. This reliance on delegation without any personal education is precisely what allows sophisticated con men like Bernie Madoff to run massive Ponzi schemes for decades.
Because the investors never asked the hard questions.
Never. They were blinded by supposed expertise and the promise of security.
Level 4, The professional do-it-yourselfer. This is where personal responsibility really starts.
This is the S quadrant personality focused on investing. They take full responsibility for their financial education. They know how to distinguish between financial facts and financial opinions. They're willing to start small, invest their own money, and commit to continuous learning.
They embrace the mistakes.
They understand that making mistakes is essential to learning as long as the cost of those mistakes is small enough not to cripple them.
And finally, level 5, the capitalist, the top of the pyramid.
The capitalist is a B quadrant owner investing in the I quadrant. They don't use their own money, they use OPM. They operate with a smart, integrated team of lawyers, accountants, and brokers. They know they don't have to be the smartest person in the room, they just need the smartest team. And critically, they enjoy massive tax advantages because they leverage corporate structures.
And the sources say that once you're successful in the B quadrant, raising capital in the I quadrant becomes easy.
Because success attracts money. When a company like Facebook or McDonald's does a stock offering, they raise billions instantly. Why? Because they are proven B systems. They've demonstrated they can operate reliably and generate massive cash flow. And the money they raise, it often comes directly from the level 2 and level 3 investors who park their savings in banks and pension plans.
So the capitalist organizes the system and the savers provide the fuel.
That's the game.
So after this deep dive into cash flow and systems, what is the ultimate definition of wealth in this framework? It's clearly not about the dollar amount in the bank.
Absolutely not. Wealth is measured in time, not dollars.
Hi.
It's defined as the number of days you can survive without physically working while still maintaining your current standard of living. If your monthly expenses are, say, $10,000, and your passive income from assets is also $10,000, your wealth is infinite. You're financially free.
So financial freedom is just when the cash flow from your assets perpetually exceeds your monthly expenses.
That's it. And the key takeaway here is that investing success, it starts in your mind long before any money is actually exchanged.
Money is seen with your mind, not your eyes.
That's the phrase. The ability to make money with money starts with mastering financial words and numbers. Being uneducated is risky. Investing is simply the management of risk. If that financial knowledge isn't first established in your head, any money that comes your way just won't stick to your hands.
Okay, let's talk about the rules of the road. Because according to the source material, capitalism is a game with very specific, very powerful rules, and the average person is playing without even reading the manual. What's the fundamental name of this game?
The name of the game is simple. Who is indebted to whom?
Who is indebted to whom?
The rich, the B's and I's. They have systems and assets that make other people indebted to them. The poor and middle class, the E's and S's, are indebted to everyone else. The bankers, the government, the credit card companies. The more people you're indebted to, the poorer you are, no matter what your income is.
And the main reason people on the left side lose this game is that they make a huge mistake right from the start. They mistake liabilities for assets. And this is the cornerstone of the whole philosophy and the most controversial part. The idea that your house is not an asset.
I know that just runs against the entire American dream narrative, so let's be very specific about the justification here. A true asset puts money into your pocket. A liability takes money out of your pocket.
Simple definition.
Very simple. And the average person's house is a liability because it generates expenses, maintenance, property taxes, insurance, mortgage interest. It constantly drains your cash flow.
But wait, a lot of people use their house as their primary retirement vehicle. It's their hedge against inflation. I have to ask, how do the sources justify calling the primary retirement vehicle for the entire middle class a liability?
The source material argues that while, yes, the house may eventually be sold for a profit, the cash flow during the years you hold it is negative. And furthermore, the property tax example is critical. If you stop paying your property taxes, you quickly find out who the real legal owner is, the government.
They'll take it from you.
And here's the most telling point. Your mortgage, your debt, it shows up as an asset on the bank's balance sheet. Your liability is their asset. And that's why they aggressively market mortgages to the E and S quadrants.
And the word mortgage itself is revealing.
It is. It comes from the old French word mortir, which means agreement until death. It just underscores the reality of this multi-decade debt commitment that the middle class takes on, often encouraged by tax breaks for interest payments, which just entrenches them further in the system of debt.
Let's talk about those tax differences because they provide the ultimate motivation for moving to the right side. How does the earning pattern differ between ES and BI?
For the ES employee or professional, the sequence is fixed. Earn, taxed, spend. The government, through withholding, takes its share first. The employee only receives a fraction of their income, which they then use for spending.
So if you earn 50 grand, you might only see 30 after taxes.
Easily. But for the BI person operating through a legitimate corporation, the sequence is completely reversed.
Also,
It follows the sequence. Earn, spend, taxed. The corporation earns the income, and the owner uses pre-tax dollars to cover legitimate business expenses before the government calculates tax on the small remainder. This is the legal use of the tax code to shelter income and accelerate wealth.
this sounds incredibly powerful, but we need some tangible examples.
Mm.
What specific expenses can a B-type legally deduct pre-tax that an E-type is paying for with post-tax dollars?
Think about all the costs of earning an income that an E-type pays with heavily taxed dollars. For a B-type, expenses like vehicle leases, legitimate business travel, business meals, professional development, even using part of their home as a deductible office space, all of that can be paid with pre-tax dollars.
So the BI owner gets to pay for their lifestyle first.
They essentially pay for their lifestyle first and then pay taxes on what's left. It's a massive advantage that increases both their available capital and their asset protection.
And the sources make a really strong case that these tax differences caused a specific, massive transfer of wealth in recent history, the 1986 Tax Reform Act. We need to detail this mechanism.
This is so crucial for understanding the financial game. Before 1986, many high-income E's and S's, like doctors and lawyers, would invest in real estate partnerships. They did it specifically to generate paper losses calculated for tax purposes, often involving depreciation.
And they use those losses to offset their high salaries.
Exactly. It sheltered their wages from high taxes.
Mm-hmm.
But the 1986 Act eliminated those paper loss loopholes for high-income E's and S's, which made those real estate investments financially punitive for them. All of a sudden, they lost their tax incentive, and it led to this massive sell-off of properties.
Creating a real estate crash.
A huge one. And who benefited from this distress?
The B's and I's.
The B's and I's who understood the true nature of assets and liabilities. As the savings and loan crisis got worse because of the crash, the government created the Resolution Trust Corporation, the RTC, to liquidate all these foreclosed properties. People on the right side who had the knowledge, the systems, the capital, they bought these assets for pennies on the dollar.
A massive wealth transfer.
The sources describe it as a blessing from financial heaven for those who are prepared. It was a massive, legally mandated transfer of wealth from the financially uninformed left side to the astute right side.
It just demonstrates that market chaos isn't a time for panic. It's a time of unprecedented opportunity if you're prepared. And that preparation also includes being able to create money through smart structuring.
This is the skill of playing the bank. Let's walk through the example of buying a house worth $100,000 for $80,000 in a distress sale. The I-type investor secures financing for the $80,000. Then they advertise the house with very specific language. Owner desperate, no bank qualifying, easy monthly payments.
So they're targeting people who can't get a traditional loan.
Exactly. They sell the house for the full $100,000 to an E or S buyer who can't qualify for a bank loan. The buyer doesn't pay cash. They agree to monthly payments.
So the investor creates a loan.
The investor creates a note, a legal interest-bearing promise to pay the remaining balance, and that note generates $30,000 in income over time. That's the $20,000 price difference plus a $10,000 down payment. You've essentially just created a $30,000 asset, the note that didn't exist before, and it generates cash flow.
And it's tax advantaged.
Crucially, that $20,000 capital gain on the sale was structured to be tax-deferred or entirely tax-free because the investor is operating through a system that plays by different rules. For an E-type to save $20,000, they would have had to earn nearly $40,000 in wages because of taxes.
The ability to act as the bank, structure the deal, and create tax-free capital is a defining skill of the B and I quadrants.
It is, but the transition from the left side to the right side, it's not one giant leap. It's a process. It requires intense commitment and discipline, and the sources really emphasize the power of taking consistent baby steps.
Right. It's not about the size of the stride.
No. Long-term financial success is measured by the direction you're moving and the number of steps you take.
And we keep coming back to that problem of analysis paralysis, especially for highly educated people who are trained to find the perfect answer before they do anything.
Action just beats inaction. People who are trapped looking for the single right answer, they're paralyzed by that fear of error. True learning requires mental, emotional, and physical engagement, and that comes from doing and failing and adapting and trying again.
The sources identify 3 common qualities in the self-made wealthy.
A long-term vision, a commitment to delayed gratification, and a deep understanding of the power of compounding of money, knowledge, and experience.
Okay, let's walk through the 7 steps defined in the sources for starting this journey. Step 1 is mind your own business.
This is a real wake-up call. Most people are programmed to mind everyone else's business. Their bosses, their bankers, the governments. Step 1 requires you to fill out your own personal financial statement, the income statement and balance sheet, to establish the cold, hard reality of where you are financially.
So you have to face the numbers.
You have to face the numbers and set realistic, measurable financial goals that are focused on passive income, not job income, for the next 1 to 5 years.
Step 2, take control of your cash flow.
This is the absolute core of financial discipline. People who can't control their personal cash flow will always work for those who can. And the most important actionable step here is the mantra, pay yourself first.
What does that mean exactly?
It means you set aside a fixed percentage from every single paycheck immediately into an investment savings account. And the rule is simple. You never take that money out until you are ready to use it for an investment that generates cash flow.
How is that different from just saving money?
Saving implies setting money aside for general use or emergencies, which, as we said, is vulnerable to inflation. Paying yourself first means setting money aside specifically to acquire income-producing assets. You treat that allocation as a non-negotiable expense, sometimes even before you pay consumer debt.
And the sources also talk about getting rid of consumer debt fast.
Very fast, especially high-interest credit cards, cars, then mortgages. By following a dedicated debt snowball approach, most people can be completely debt-free in 5 to 7 years.
Step 3, know the difference between risk and risky.
This goes right back to financial IQ. Business and investing, yes, they are inherently risky activities. But being undereducated is what makes them risky for you personally. Financial literacy trains your mind to see the direction of cash flow and understand how to manage or mitigate risk.
So an uneducated person just sees risk and runs away.
They'll always say, investing is too risky. An educated investor sees the risk, knows how to manage it, and moves forward anyway.
Step 4, decide what kind of investor you want to be. This is about how you approach problems.
Right. You have to recognize that investors fall into 3 types. Type A seeks out problems. They look for opportunities in financial trouble or market distress. Type B seeks answers. They buy the packaged retail investments marketed to the masses. And Type C seeks experts. They just rely on others to tell them what to do.
And Rich Dad encouraged becoming a Type A.
Always. Solve the business and investment problems that others overlook. That's why Bill Gates solved software problems and Donald Trump solves real estate problems. Solving problems creates wealth.
Step 5, seek mentors.
A mentor is someone who has already successfully navigated the path you want to travel. And crucially, the sources warn against seeking financial advice from people who are themselves stuck in financial struggles, no matter how well-meaning they are.
The sources suggest an exercise here, the idea that you are the average of the 6 people you spend the most time with.
It's a powerful one. Write down those 6 names. The list can be shocking because you are literally looking at your financial future. If you want to change your future, you have to change your thoughts, your knowledge, and, very often, the relationships and conversations you maintain. Seek people who are already where you want to be and learn from them.
Step 6, make disappointment your strength. This ties back perfectly to the mental fortitude needed to overcome the fear ingrained by school.
Disappointment is not a wall to hide behind. It's a priceless gem of wisdom, but only if you extract the lesson. The reason so few self-made rich people exist is that few can tolerate the emotional sting of disappointment and failure.
So you have to expect it.
You must anticipate setbacks, not negatively, but as essential learning experiences that allow you to remain calm and think clearly when things inevitably go wrong. Rich Dad's quote on this is perfect. The size of your success is measured by the strength of your desire and how you handle disappointment along the way.
And finally, step 7, the power of faith.
This step underpins the entire shift. It's the need for faith, trust, and courage to overcome the most paralyzing obstacle of all, which is fear. It's that internal voice that says, you can't do that, you'll lose everything.
That voice is often just projecting its own limitations.
Exactly. It often means they cannot do it, not that you cannot. You have to be prepared every day to be bigger than your own smallness and the self-limiting beliefs that are imposed by fear.
This has been an incredible immersion into a truly transformational philosophy. We've seen that true financial success it's fundamentally about a change in identity. It's not about what you do, the job you hold, but about who you become. A, B, or an I mindset focused on systems, leverage, and emotional mastery.
Mhm.
The old safe advice of get a job and save money it's financially obsolete in the information age.
That is the essential conclusion. We are entering an era of tremendous change and volatility, driven by the timeless forces of greed and fear. And history shows us again and again that great, rapid transfers of wealth always occur during these upheavals.
The B's and I's get richer.
The financially informed, the B's and I's, they often position themselves to capitalize when the financially uninformed E's and S's are panicking. If you know the game, you get to choose which side of that wealth transfer you want to be on.
The ultimate wisdom, drilled into the source material, remains so powerful and clear.
It's simple. Build businesses and buy real estate. Focus on creating systems that generate passive cash flow, that utilize OPM, and take advantage of the legal tax sheltering provided by corporations. Don't focus on earning high wages only to be taxed first and then spend what's left.
So the takeaway for you, the listener, is to consider the ultimate question of this financial game. Given that we all play this game, and the rules are inherently stacked against the financially uninformed, what systems, not jobs, will you start building today to ensure your financial future is not left up to chance, the government, or the whims of the market? Think about where your cash is flowing and choose your quadrant wisely.